And healthcare has also underperformed. That tends to be a defensive category as well. So what might explain this? Well, it could be that the market paying attention in all its wisdom, even if the Fed wasn't, the market was paying attention. We were in a bear market last year, and the market was saying something's going to break here. And now we know what it is. Is there a buy on the news, or a buy now that we're near the end of this? As I just mentioned, I'm not sure we're near the end of it. I don't know why deposits are going to flow back into the banking system, given current dynamics. But if we are about to experience, some people would say soft landing. I find it hard to believe this will be soft. But soft or hard landing, what that will mean is inflation and interest rates are going to continue coming down, and the Fed will follow them finally. The markets always lead the Fed. So that could be what's going on here. If you remember what happened, our strategies, innovation-based strategies, they started underperforming in February of 21. When the whiff of inflation and interest rates going up with supply chain issues started, and the market just started discounting, saying, interest rates are going to go up at some point. This category of stocks is not going to do well. Well, we could be on the flip side of that, because it does seem like innovation-based strategies have done very well. When it comes to fixed income markets, the 10-year Treasury bond yield peaked in October last year, 4.3. It did get to 4.1% in March, but then the crisis took care of that, and we're now down to roughly 3.5%. So we're down to 3.5%, perhaps because of a flight to safety, and perhaps because whatever kind of landing this is going to bring with it lower inflation and interest rates. And if deflation is the risk, that actually accrues to the benefit of stocks that do well during deflationary times. And that tends to be technology. Technologically enabled innovation is deflationary. Now, the yield curve is telling us that we're not out of the woods yet either. It did drop to more than 100 basis points of inversion on March 8th, and the crisis took care of that. But we're still inverted at 58 basis points today. So now many people looked at the 100 basis points and they said, oh, well, the last time we were here was in the early 80s. We got inflation under control with 100 basis points inversion back then. And that's true. But I think the analysis is a bit off. It basically underestimates how powerful Fed restraint is today. Because 100 basis points or 1% against a 15% long bond yield is a lot different from 1% against a 4% bond yield. So 1 over 15 is 6.5. Use the Richter scale here. 6.5 on the Richter scale is a pretty powerful earthquake. I've been in a couple of those, and they are not pleasant. They're actually quite eerie. 1 over 4 would be 25 on the Richter scale. We've never seen an earthquake of that magnitude. In fact, I think the highest has been 10. So I think if we look at it from that point of view, that the Fed has been making a mistake, and we are going to see more ramifications of this.